Okay, we are live, Steve.
Well, we'll wait a couple of more seconds. I think everybody has logged in, but good morning, everybody. And I say good morning, and then I checked our signee sheet, and it looks like we've got three different time zones. And so I did my quick math with the world being round. I think it's still morning for everybody that's on the phone, just or on the webinar. Some are just earlier than others. So we do welcome everybody to the Stop Stressing and Start Planning webinar. Our goal is to answer some questions, but at the same time, we actually may create some more questions for you. And that's good. I mean, that's the purpose of these things, just to have a discussion. Quickly, I'm going to do a brief introduction. Again, I'm Steve Kessner. Most of you know who I am. I'm here in Oklahoma City. Jamie Kessner, and as most of you can tell by the last name, she is related. She is my daughter. I tell everybody we have 5 children, now 6 grandchildren. She sometimes like to introduce herself as my favorite daughter. So we'll
Because
let
I
her go with
am.
that today. She's coming to us from our Minneapolis office. And then we've got Karen Ibe. She is with JP Morgan Asset Management. She lives in Oklahoma City, but she told me she's actually in Memphis. So we're represented from Memphis this morning. And then Thomas Maple is with Transamerica, and he is actually in Tulsa this morning. He changed his schedule for us. So we are representing different countries or different states right now. So anyway, with that being said, again, welcome everybody. And Jamie, I'll let you go a little further into introductions, a little overview.
Yep, let me see here. I'm going to start sharing my screen and see if we can get this pulled up here. 1 second. Okay. Let's see here. Can you guys see my screen?
We can see it.
Oh, you can't see it? Okay. Then
Yep.
perfect. Okay, let me go through here. So just to kind of overview for table of contents, well, let me actually hold on 1 second here. There we go. Okay, so yeah, introduction. This is going to kind of go over table of contents for things we're going to discuss. So again, we'll talk about current market conditions, which I know is on the forefront of everyone's minds right now. We'll go into the hidden cost of emotional investing. We'll talk about the sequence of returns, which we call the retirement wild card. And then we're going to kind of introduce you guys, which some of you are already familiar with, is the bucket strategy. And then we're going to kind of get into the role of equities in retirement portfolios. And that's when Karen Ibe from JP Morgan Asset Management is going to say a few things. And then we'll have Thomas Maple with Transamerica touch on, creating stable income in retirement. And then we'll see how much time we have for Q&A. And we did have some questions that came in ahead of time that we're going to try to address as well. But again, as my dad said, we're Iron Horse, and one of the things that we always like to take the time to make sure we address is that we do investments, financial planning, asset management, but the estate planning also means we do wills and trusts and probate as well. So again, ideally, we want to be the one-stop shop for you guys. You guys can come in. We help with tax planning, financial planning, investment management, college planning, retirement planning, and all my dad's fancy degrees, the CFP, CPA, attorney, and chartered advisor in philanthropy, which he always says just means he didn't know what he wanted to do when he grows up, but allows us to do more of the comprehensive planning. And then, as he said, I've been with him for about 13 years. I'm in the Minnesota office, but I'm back in Oklahoma about every 4 to 6 weeks. I'll be back the beginning of May as well as the next trip home. Okay, and then Steve, if you want to kind of kick off into current market conditions of what everybody is talking about.
Yeah, and one of the things in the bio says that, I've been doing this for over 35 years, and which means up until about 2 weeks ago, I was telling everybody I now had three once in a lifetime events happen during my financial career. Depending on how the tariff thing works out, it could be four. And then I don't include 1987 because even as old as I am, that still was before I actually started doing financial planning. But we still need to look at what has happened? And our biggest concern, there's really three phases to investing. It's the accumulation phase, and then we have preservation, and then we have distribution. When we're in our accumulation phase, we really don't pay much attention to the market going up and down because we know when the market's down, we're actually buying stuff on sale. But when we get closer to preservation and to the distribution, we get more concerned about market conditions. And again, if you look at these events, these are the top 10 worst single day percentages in the history of the US stock market. And number one is 1987 in Black Monday, where the market actually went down over 20%. And this is the S&P 500 in one day. Now, let me put this in perspective. That on the S&P represented only a 58-point drop, and it was only a 508-point drop on the Dow Jones. So we need to look at percentages and not points when we look at these drops. Now, the other thing you need to look at is the second column. The red column shows the down. The second column shows how many days did it take to recover to get back up to where the high was. Where was it after 1 year? Where was it after 3 years? Where was it after 5 years? The only one that sticks out is 2008, and it saw that it took 410 days to get back to its high. Now, what do these all have in common? The have in common is everybody says, well, it's different this time. All right. Let me read you a headline. And it said, what caused the market crash? And they said it wasn't a single event, but a combination of factors. It included rising global interest rates, a trade deficit, a declining dollar, and inflation concerns. Does that sound like today? Yeah, it
Yes.
does to me. Yeah. Well, guess what? That's what happened in 1987. So maybe it isn't different every time. The other thing I will point out in 87 was that's when they first started really the computerized program trading. And it, you think, I guess kind of what AI has developed, but back then they had buys and sells. And when the market started going down, it started triggering sells. And the thing was like a runaway freight train. Now they've put brakes so they don't let the market drop that much until they have a pause. So we don't see those drops. But just kind of look through there. Again, COVID, everybody thought that was once in a lifetime. That's number 2 and 3. 2008, the global financial crisis, again, that's the one that lasted the longest. And then we go down there again in 2000, which was really 1997 through 2000, we saw a drop. Those are the major significant drops in the market.
Well, yeah,
So,
and the other thing that I think is worth pointing out is as of market close last Tuesday, so the S&P 500 was down 12.1% for the previous 4 trading days of those 4 trading days together, which was the 12th biggest 4-day decline since like 1950. But what happened in the past following the biggest 4-day declines, it was that stocks moved substantially higher over the next 1, 3, 5 years every time, which is what this chart is showing. So essentially that, and also this chart doesn't include reinvested dividends. So if you look for 2008, if you add in reinvested dividends, I believe it's actually not negative. But I know a lot of times because when people are like, we don't know what's going to happen in the next couple months, or again, this time is different. Historically, after we have an experience like this, stocks do end up rebounding and coming back. And we'll kind of get into timing the market and some of that as well. And this is kind of to your point, Dad, about this time is different.
yeah, I call this chart, my flying W chart. When you look at it individualized, these look like big drops. When you spread it out, and actually the chart, I couldn't find one that went back to 87, but it starts in 90. So you really have a what, 35-year chart here. You can see how it sort of evens out the ups and downs, but looking at it 35 years, you can see that, I mean, it's not straight up, but the trend is going up over a period of time. Now, everybody's going, yeah, well, I don't have 30 years. I don't have 10 years. I'm getting ready to retire now. I'm already in retirement. So what do I do when the market pulls back? And that's what we're going to talk about in the rest of this webinar is some strategies that we can use to help smooth out these ups and downs.
And I want to also address too the emotional investing. And I will say, and we'll kind of get into this too, and probably more so on a different webinar when we kind of get into risk tolerance. But there are times, again, when you have CNBC on and you're reading all the headlines and you're hearing all the doomsday, that people say, okay, I just want to go to cash. I just want to get out. I'm too nervous. This time is definitely different. Like I'm nervous, and just kind of want to quickly touch on the significance of letting your emotions dictate your financial plan, because emotional investing leads to costly mistakes. Not to mention, market timing is nearly impossible to get right. And if people could get it right, then there would be a lot less people giving advice and more people living on private islands somewhere. Not to mention, missing just a few key days when you make that emotional decision have effects on your long term. And so here's kind of just an example. Let's just say an investor put in $10,000 on January 3rd in 2005. They put it into the S&P 500. They let it sit and do its thing until December 31st on 2024. So they're riding out those market volatility, the dips. Again, you have 2008 that was in this, but they didn't have any emotional reaction to it. If they remained fully invested, the ending portfolio balance would be 71,750. Now, look at just below that, missing the 10 best days. So making that decision of, I'm nervous, I don't want to be in, like, take me out. The question that we always ask clients if they come to us and say this is like, okay, when are you going to feel comfortable getting back in? Because missing the 10 best days reduces that total portfolio balance to 32,871. And then if you go down to the very bottom of missing the 60 best days, because again, a lot of what we hear right now with tariffs is, I just want to get out. Maybe in 6 months, look at getting back in when I feel more comfortable. But missing the 60 best days, you actually end up with a negative return. So this is just the same thing showing the percent return. So you'd have a negative 3.7% return just by letting your emotions dictate when to be in and out. And then again, that's when we kind of get into the strategy, because we understand, like, it's nerve wracking, especially when you're heading into retirement, when you look at everything that you've accumulated and saved so far. Like, it's nerve wracking to see red, even though that should look like a buying opportunity. This is kind of also what we want to talk about before we, sorry, get into the strategy, is just the sequence of returns, because that's really what you should be focused on, is not necessarily the accumulation phase, but then what happens when you're taking the withdrawals when you're in retirement.
Yeah, I can say it's easy to stay invested when you're accumulating because you're saying I'm invisible and bulletproof and I'm not going to retire for 20 or 30 years. It gets harder the closer we get to retirement or when we are in retirement. So one of the things we're going to talk about later on, and we'll show more specifics, is the bucket approach. And this is where we use some of Karen's funds and we use some of Thomas's, the Transamerica. And a lot of you on this call have the JP Morgan. You may not even know it. You've got funds in your accounts right now. And some of you are in Thomas's Transamerica annuity. So we'll talk about that in a minute too. But look at these. I want you to look at these slides. And if you can see them, they look exactly the same. On the left is Vado, and on the right is Maverick. And I'm going to put an asterisk. Vado is Jamie's dog. Maverick is her fiance's dog.
Yeah, so if they sound like dog names, it's because they are.
So if you first glance, and there's a lot of numbers on these charts, and I want to tell you, you're right. If they look the same, they are. They're exactly the same except for two things. In both cases, and again, we didn't pick any years specifically. This is really just a math equation. But we have 15 years where they each invested $100,000 and they each started pulling out 5% or $5,000 a year, and they each made 4% return. So if you would go down and average out those returns on the right side, it's going to come out an average of 4% a year. The two differences are, on the left, when Vado invested, he had good years up front and his bad years were at the tail end, where Maverick was unfortunate enough to invest when the market was going down and then had the good years at the end. That's one difference. The other difference is Vado ended up with 105,000. That's after investing 100, 15 years, pulling out $5,000 a year. Maverick started with 100, pulled out $5,000 a year, ends up with $36,000. I also think there's subliminal here. Again, Veto's Jamie's dog. Maverick is Tyler's, her fiance's dog. So I'm thinking that's why Maverick didn't do as well. That's probably why she named it. But anyway, so the key here though is, again, both of these are it's if the average return is 4%. So you can't just look at returns. You have to look at what the account balance is when you're pulling money out. And that's where we come in to try to come up with some strategies to try to, I'd say, even the playing field and make sure we don't end up like Maverick on here.
And I'm a visual learner, so taking that data and then visualizing it just so you guys can see too, and then also with pictures so you can see Vado and Maverick. But yes, Vado retired when the markets were up, and Maverick retired when the markets were down. But again, you can see just with the withdrawal rate. And so if you're looking at this and you're like, okay, yeah, but I'm about to retire, and if we end up in a down year, what does that mean for my portfolio? Am I going to be a Maverick because I want to be a Vado? Do I need to work longer? And so that's what my dad's saying, is that this is where we come up with the bucket strategy that helps mitigate a Vado and Maverick situation.
Yeah, I would say that you don't want to be a Maverick unless you're Top Gun. That's probably the only time we want to be a Maverick. But so here is a picture, and I'm going to give credit again to another one of my kiddos. My son lives in Austin, is a graphic designer. He designed this Christmas card for us that we sent out this year. But the whole theme of the Christmas card is, as Jamie said, we don't have a crystal ball. And I've said this for years that, my magic wand's broken, my crystal ball doesn't work. We don't know what the market's going to do, but we do have strategies to react. And it's kind of like we thank you, the movie Twister, because we got our Christmas card from there. But we do have storms, and there are going to be storms coming. That you saw that graph. The market never goes straight up. There's always dips. So this is why we developed, and I shouldn't say we use the bucket strategy, and it's the strategy and how we fund the buckets that make the difference to try to even that up and down. So Jamie, you want to talk a little bit about that?
Yeah. So essentially, what it looks like is, and this is different for each investor, and everyone's plan is going to look a little bit different. So just know this is just a general idea to get you an idea on how we set it up. We have bucket 1, bucket 2, and bucket 3. The buckets signify different accounts. So your bucket 1 is your immediate income. So this is your paycheck. This is years 1 through 3. This is, again, what you're using to pay your bills, vacations, immediate expenses. Then you have bucket 2, which is we're not touching that for another 4 years. So while, yes, you are in retirement, we're not taking funds from this account yet. So we might have this invested, again, for general purposes, into a moderate range, maybe looking at a 4 to 5% return, depending on exactly the client's risk tolerance level, what the goals and objectives are, et cetera. And then bucket 3 is our long-term bucket. We're not touching this until 12 years from now. So this is our growth bucket. This is the bucket that, could be lifetime income. And we'll get into kind of that in just a minute too. But the whole idea behind this is when you're taking income in years 1 through 3. So if you retire right now, I'm going to start taking income. We're taking it from the immediate income. We're taking it in this bucket, not this one. So it prevents the sequence of returns. So if the market's down, we have this invested in cash, essentially. So you're not having to take money out. If there is a 10% pullback, you're sitting in cash. It's this bucket that's having that and has time to come back in, recover on that. And we'll kind of let Karen Ibe from JP Morgan kind of say a few things, because again, and bucket 2 is really where we see equities. Because like we said, we want fixed income, essentially some conservative in bucket 1, but have equities in bucket 2 with growth and income. And we'll kind of turn it over to her to kind of talk about the role of, how equities can play a part in bucket 2 and also bucket 3 for income as well.
Well, good morning, everybody. Thank you for taking time out of your Wednesday morning to have a conversation around the markets. Certainly, there's no shortage of things to talk about. It's been a very interesting year in terms of the market movements. But I think it is important just to have a conversation about why we need those equities, why buckets 2 and 3 are so important, particularly when you think about planning for retirement. The reality is that we have to plan for a very long period of time in retirement, sometimes upwards of 30, 35 years is some of our planning strategies. We now take that long-term of approach. And the number one feedback from clients is, I'm never going to live that long, right? So the challenge is, my dad turns 88 this year, and he's ever since he retired at 62, he said, I'm never going to live that long. And here he is at 88. And so it's really critically important to not just think about the very short term once you get in retirement. The reason that we need equities in retirement portfolios is we need that portfolio to grow so that it can last for a very long period of time. But more importantly, we need it to keep pace with inflation. And inflation is normally a very boring topic when it comes to investments and finance. It's kind of like watching paint dry on the wall. But really, since 2022, inflation has been the star of the show, because post-COVID, post all of the money that was introduced into the economy to keep us from going into a deep, deep recession during that time, had the impact of raising inflation. And inflation rates in 2022 got up to near 9%. I've got 2 teenage boys, and I have my own personal inflation barometer called the bacon barometer, of how much I pay for a pack of bacon at Sam's Club. At the height of inflation, I was paying $19 for that pack of 72 slices. Now we're back down to a more reasonable 13, 14%. But that's very real. And you see inflation, doesn't matter if you think of yourself as a big spender or not, in retirement, just keeping pace with the necessities. Now, we could argue that bacon's not a necessity, but keeping pace with the necessities of retirement means that we have to invest in equities as a portion of the strategy to be able to keep our ability to purchase goods and services in the future on target. Now, during periods of volatility, I always like to remind investors, most of the time, we live in an investing world where equities do quite well. And in fact, 75% of the time, the equity markets end up positive. And that's why Steve's flying W chart works the way that it does, is because most of the time, stocks do quite well. And the reason they do that is because what we're investing in when we're investing in equities is we are investing in companies that produce stuff that people want to buy, goods and services that people want to buy. That translates down into earnings. And as shareholders of the company, we get to share in all that future earnings growth. So if you find good quality companies, and that's our job as professional money managers, particularly at JP Morgan, is to find the good quality companies that you want to invest in, you're going to have earnings grow over time. And that's what's going to produce that chart that Steve showed that's upwards and to the right over time. Now, the reason, that we're going through this more recent volatility, and I'm sure we'll have questions on tariffs and those type of things, but what's happening is that right now, the earnings picture is a bit murky because we don't know what the future is going to hold in the very short term around tariffs and the pause that's currently on tariffs and caused the market to do a really nice rebound. The challenge is that companies still don't know how to promote their earnings to the investing world so that we can get a good gauge on whether we're paying the right price for those equities. So that's why you're seeing the market movements that we've seen. But I want to emphasize that staying invested matters the most. And if there's anything that you take away from my little short segment this morning, it is that markets perform well, but market timers don't. And the reason why is that slide that Jamie showed, which is, if you miss those best days for investing, it really puts a huge catch up on your portfolio that you need. And the real kicker, I call it rain and rainbows, but those worst days are usually followed by the best days, usually within 2 weeks of each other. So the rain comes first, then comes the rainbow. That's exactly what we saw a couple of weeks ago. Worst day for the S&P 500 this year, down 6% on April 4th. 5 days later, April 9th, there was an announcement of the 90-day pause on tariffs. The market was up 10%, 10% in a day, which is going to go down on one of those best days in chart, third best day since 1950. And so I just want you to think about that. When we go through difficult periods, the rain, when you're going through the rain, when it comes through your investing portfolio, stay invested because the rainbow is coming and it's usually coming very, very quickly. The other thing that I like to highlight about that is that if you look at what those 10 best days were, when you go back over that 20-year history, I can tell you what you're not going to tell me the year that they occurred in, but the days that they, or the years that they actually occurred in were 2008, 2009, and 2020. So the height of the financial crisis, the height of COVID, and now this day that's going to go down as the third best since 1950 as the height of this tariff trade conversation that we're currently in. So just remember, this is temporary. We don't know exactly when it's going to recover, but the market has never failed to recover. Remember that. The stock market here in the US has never failed to recover. And that gives me a lot of hope. And so when I share that with my dad, he's like, that's great, but I don't know if I have time for it to recover. So we focus on generating, defense equities, but with a more defensive nature, and focusing on incurring substantial income today. And that's some of the products that Steve and Jamie use from JP Morgan. Some of you might know them, JP Morgan Equity Premium Income, JEPQ, JP Morgan NASDAQ Premium Income. The whole goal of those two strategies is to provide conservative exposure to the equity market, but produce substantial income. And when we talk about substantial income, JEPI produces 7 to 9% current income paid out monthly. JEPQ produces 9 to 11%. And so these are appropriate for clients who, one, have the risk tolerance to stay invested. The most critical thing is that you stay invested. The second thing is that these are appropriate for clients who are willing to give up some of that flying W growth in exchange for the current income today. And that's why they put it in the buckets that they put it in with the strategy at Iron Horse, is because it fills the need for clients who want to take that current income today. So in the interest of time and future speakers, I'll pause there, but happy to address any questions when we get to the question and answer portion.
Yeah,
Awesome. Thank you, Karen.
And Karen, I'm just going to point out what your point about retiring. We used to tell people you're just retiring, not dying. Okay. And in this day and age, you can spend as much time in retirement as you did in the workforce. So again, it is important. And I had the same conversation with my dad when he got ready to retire, but it was 1998 when he retired. And he said, what happens if the market drops right after I retire? And what happened? 2000, and we had a 40% drop. Well, at that time is when we actually used some stuff like Thomas is, I think, going to talk a little bit about, because he was very conservative. He was more concerned about losing, but he wanted some kind of stable income. And that is a discussion that we have with clients. And again, we want to stress everybody's buckets are different. There is not a one size fits all. We customize each one of these based on your risk tolerance. And that's what Jamie can talk about. We've got numbers on these buckets. And for you that have taken the risk tolerance, you understand. For those that haven't or think that your risk tolerance has changed, we're more than willing to send that to you again and reanalyze the risk that you want to take on that. So Jamie, you might explain a little bit.
Yeah, because like Karen said, the whole idea is we want to make sure you stay invested. And I always kind of compare it to spice level. And my dad and I are pretty similar on this too, or we cannot handle spice. Like someone else's level 2 spice might as well be my mouth is on fire, like cannot handle it, like tongue burn. So everyone handles it something different. So that's kind of where you see the risk numbers here is we want you to stay invested. And so we want to make sure whatever volatility is occurring that you feel comfortable with what your portfolio is experiencing. So we want to make sure that we design it in a way that, again, you feel confident in your plan, that you understand the risk that's in there and that you can sleep well at night with that. But we also understand that there's some people that are just like, I can't handle any risk. Like I like the idea again of stable income and a pension and, understand equities are a necessity, but still way more conservative. And that's where we kind of want Thomas to come in with Transamerica and just kind of talk about the role of having stable income in retirement and the benefits of that.
Absolutely, Jamie and Steve. Thank you guys so much for having me on the call, and I appreciate everybody joining us as well. One thing that I wanted to talk about, even though I cover the annuity side, Steve and Jamie know that I love the 10-year Treasury, and I watch it, and I watch it very closely because it controls a lot on the insurance company side and from the annuity standpoint. So I did a little bit of research on it, and I know China has become a topic of discussion recently, but about 5 to 6 years ago, China had over $1.3 trillion of our 10-year treasury. And as they bought it, the 10-year treasury continued to go down because they continue to buy more and more of it. Now China owns about $760 billion of our 10-year treasury, so almost half of what they had about 5 or 6 years ago, which as they're selling our treasuries, it actually causes the rate to go up. So a little bit inverse of what people think. But as you sell a bond, the price of it goes down and the yield goes up. Now, Japan actually is the largest holder of U.S. treasuries in the marketplace we have today. And they're starting to sell it a little bit as well because their treasuries, they bought so much of it because their treasuries were so low in yield. And now their treasuries have continued to increase. And if you think about Japan, they were basically in a stagflation era for almost 25 to 30 years. But as their rates start increasing, now they're selling our treasuries and buying some of their own treasuries, their treasury equivalents at least. One of the things that affects clients, not just the sequence of returns, but the longevity risk as well. And so if you are living, as Karen said, her dad is 88 years old, but at 62 didn't think he was going to live that long. Most of us, when we were born, our life expectancy was in the 65 to 70 year range, but we're getting there. And the number one growth in Hallmark cards is actually in the 100-year-old card and above. And they think here soon they're going to be publishing 105-year-old cards because of how long people are living. That's due to a lot of factors, but as people live longer and longer, that's longevity risk. If they live too long, they're scared they're going to run out of money. That's one of the roles that annuities play, is the lifetime income they can provide. They provide both fixed income investments and also equity investments. And as Steve and Jamie said, they can customize those. They're highly customizable products when it comes to the underlying investments. But the income that they provide in bucket 3, even late stages bucket 2, right? They allow for you to live with that 5% to 8 to 8.5% income, depending on how long you have to wait. And they can really hedge against that longevity risk. So I know they also get rid of some of those sequence of returns as well, because they provide a underlying guarantee of income immediately if you'd like. And so back to Jamie's dogs, you want to be Vado. You don't want to be Maverick in this situation. And even if the market goes down in Maverick situation like it did, you still have a guaranteed lifetime income that cannot decrease on the annuity side. So that's kind of the thoughts on what we have on that, but a lot of different products that are out there today. Like I said, Steve has access to, I don't even know, probably 50 different annuities that he can use. And we're fortunate that he's used ours, but we think that ours is one of the best out there right now. Like I said, it just matters how long you have until retirement for how much income you can take.
And, another example I use in that bucket 3 is kind of like when you bake a cake. You want to leave that bucket 3, you want to let it mature. You want to let it, if you pull a cake out before it's done, what do you have? You really have nothing. But if you let it sit there for, again, 7 to 10 years, we can ride those ups and downs. And then, like you said, Thomas, on the Transamerica, the longer we can wait, the higher the percentage they're going to pay out. And that's another reason why we like to use it, like you said, later stage bucket 2 or bucket 3 on there too. But at the same time, with Karen's funds, we're still producing that income in bucket 2. And again, and we can use it in bucket 3. Again, it's just a matter of, we kind of work backwards. Our clients tell us, here's what I need for income. And then our job is to put together a plan that works for them.
Yeah, and that's kind of too why you see the 70 and the 1 on the risk score in bucket 3. And again, this is where, this is just a demo sample compliance. This is not a presented actual representation of how we would do this. But when we plug in the risk numbers for, annuities into the software, even though there's investments, so the cash value can fluctuate because of the stable income, it actually pulls in at a 1 because you do have that stable income, once you turn it on. So that's why you kind of see the 70 and the 1, because in bucket 3, again, we still want to have equity exposure, again, longevity, and, for the sake of not, wanting returns, but we also, if we wanted stable income, that's going to be pulls in at a 1 risk score. And this is also when we would, strategize on when to take Social Security. So, that's a whole other thing that we can get into on a different day, because everyone's like, when should I take it? And we can run different analysis. And again, life expectancy, when that pulls into the plan, because again, once you turn on Social Security, it's less you're having to pull from, your investments. But that's all part of the strategy that we come up with when someone's, trying to plan for retirement or we're building this portfolio. These are all the different lenses that we look at when it comes to this. And then I don't know if we want to get into if anyone has, some question and answers. I know there was some that we had ahead of time, and I think there was a question on Bitcoin and cryptocurrency, and we're not going to advise on that. We don't put that into the retirement plans. So that's not an asset that we are, planning for. It's too much of the wild, wild west out there for us to give any sort of thoughts on that. I was trying to think. I don't know if we can open up. I'll stop sharing my screen here and see if we have any questions.
And I'm going to point out too, I mean, politics is not an asset class. And if you go back and look at again, my Flying W, it encompasses both Democrats and Republicans. So, we're not pointing our finger again. We're just trying to look at the economics and to react to the situation again. But everybody has their own views on how that's going to work. And it does, but it's not an asset class. But again, it obviously influences what we've got for tariffs now and stuff like that. But again, that's not our job. We're not investing based on politics. But anyway.
And it looks like, I think Kelly has a question. Kelly, if you want to send it in a chat, you can send it to us and we can see if it comes through. Okay, so we did get another question that said, okay, so what did Iron Horse do through the past week of so much turmoil in the market? So this is where we have model portfolios, and then this is based off everyone's risk tolerance, again, as well, depending on how much exposure and what that level is. Because when you get your risk number, we have the downside and the upside. So within some of these portfolios, let's just say for our aggressive and all equity models, we have a model that we call the Harmony model that follows market signals. Essentially, it's tactical by nature. There's proprietary software that covers beta and standard deviation and all sorts of the technical, but they look at sectors. So depending on when certain sectors hit certain numbers is when we make adjustments. And so you guys probably saw, especially for the more aggressive investors, saw a lot more activity trading wise. And again, we're not timing the market. No, the accounts were never, fully in cash as far as like the core models, but we might have, reduced certain equity exposure at times. We might have added in, we international on certain things. And so it kind of just depends on, again, what's happening. But over the last couple of weeks, depending on the client's risk tolerance level and what the portfolio is, adjustments were made inside to kind of, again, mitigate some of the risk without timing the market. And that's why it's just a piece of the portfolio and we're not fully getting out or going in, and we're making sure that whatever the risk number is for the client, that we're within that range of the comfort level.
Did I see something pop up there about gold and an IRA too, Jamie?
Yes. Yep. Gold IRA.
Yeah. So, and again, Karen, Thomas, you can feel free to comment. My position has always been that I don't like gold and silver necessarily for, I guess, investment purposes for returns, because historically, I think gold has done about what inflation has done. My other problem is if you don't hold the gold actually? I mean, what is the reason for holding, I guess, precious metals? The problem with gold or any metal inside of an IRA, when you have to start taking required minimum distributions, you're going to have to start liquidating some of those positions to meet the required minimum distributions. And it can be an issue inside of the IRA. But I don't know, Karen, Thomas, you guys feel free to comment.
Yeah, I'll just provide a quick comment. One of the challenges with gold or Bitcoin or any of these sort of alternative asset classes, if you would, is that they don't have any earnings associated with them. It's all based on how much somebody is willing to pay for it. So just supply and demand. There's no earnings component to. So gold tends to do well in periods of stress, but to Steve's point, over long periods of time, it barely keeps pace with inflation. And so that's one of the challenges with it. Also, too, if you were to hold physical gold, which I know sometimes people want to do that, there are very high exit costs to selling physical commodities. And quite candidly, if you pass and your beneficiaries inherit that, they don't want it because it's very challenging to deal with in terms of settling out an estate. So there's a lot of drawbacks to it, but it really is a good conversation to have with Steve and Jamie.
And someone else had asked, will we get a copy of the slide deck? Yes, this is recording, and there'll also be a slide deck too that we can send out, assuming we get compliance approval for it. So I'll add that disclaimer, but assuming that gets approved through compliance, then we can send out copies.
And I think if and this is where I bow to Jamie on technology, we're going to try to have this recorded on our website. Is that true?
Yep, that's the goal.
Okay, got it. Any other questions out there?
Yeah, and the other thing that I would just say is, like, obviously, we all know the people, headlines, they want ratings, and what, depending on, politics, one side's going to say one side's going to say the other, but like our job is to focus on your specific situation, your financial plan, your long-term goals. Like our job is to help ignore the noise and take the emotion out of it as much as you can. Like that, we know that this is everything that you guys have, that this is your life savings, and this is what you're living off of. This is what you use to pay bills. This is what you're using to send kids to college or fund grandkids sporting events or whatever it might be. But we want to make sure that we're not making emotional decisions that are going to cost us in the long run. And that's why we want to make sure, again, if you want a written financial plan, let us set that up so you have the paper, the path in place, so you can visualize it and know that you're okay. Because that's what we're here to do. And if you're nervous, call us, schedule an appointment. Like, we're always more than happy to talk through. We want to make sure we stick the plan so we're not jeopardizing the future.
And Jamie's right. When I tell everybody, all those initials really did mean I did not know what I wanted to do when I grew up. But if I would go back and get another degree, it's going to be a psychology degree, I think, because we sometimes feel like we're walking people off the ledge a lot. And our goal is a lot of times to keep you from making those emotional decisions. And again, if you have any concerns, call us, talk to us, email us, whatever it is, and we'll talk it out. But we also know that, life is life, and emergencies happen and things come up, and we have to. I use another example. When I go down to the airport to fly someplace, I can go down there and get on any plane. I don't know where it's going to go. But let's say I'm going to fly to Minneapolis this weekend. I go down there, I get on the plane, it's going to go to Minneapolis. Rarely does it go straight to Minneapolis. There's going to be thunderstorms that pop up, and we're going to have to zig and zag and change around. My destination's still Minneapolis, but how we get there is not always the same. In the same way with retirement, things are going to happen between now and when you start taking money, when you're taking money, and our job is to help you correct the course and make the right decisions during that time period. Any final thoughts, Karen, Thomas?
I think we're good. I don't think we have any other questions. So, well, guys, thanks for bearing with us. This is obviously the first one that we've done, so apologize for any technical issues figuring some of this stuff out and screen sharing. But we're gonna do more of these. We did get quite a bit of interest. So if you have topics that you'd like covered or different things that come up, send us our way and we'll try and get it scheduled. But we really appreciate you guys taking the time and hanging out with us this morning.
Yes, and say hi to Maverick and Vado for us.
Yeah. And remember, be a Vado.
All right.
Thank you
Thanks,
all.
guys.
Bye, guys.
Thank you.